All right, welcome back. Today is Friday, June 17th. The markets are closed. My name is Patrick Dunuwila. Joining me today is Steve Strazza and Ian Culley of All Star Charts. Let's get right to it. It was another terrible week for stocks. It was actually the worst week for the S&P 500 since March 2020. It all started with a gap down on Monday. We gapped below that VWAP from the COVID lows there in blue that we've been talking about for weeks now. Couldn't hold it, and here we are just continuing to fall. We have that VWAP from the 2018 lows there in red. That coincides with like the 200-week moving average and the 38%, 38.2 Fibonacci retracement of the entire post-COVID rally. So definitely one to keep an eye on next week. That's around 3,500 in the S&P 500. Moving on to the Russell 2000, this has got to be one of the worst charts out there. We closed below those 2020 and 2018 highs today. You know, that was a key level we talked about last week, and we couldn't hold it. So just a really ugly picture there. And it's below the VWAP from the COVID lows, the VWAP from the 2018 lows. So we really need to reclaim that level around 1700. So that's a key one to focus on next week. If it can't get back above there, then very ugly. But let's turn our attention to the sectors. The big story this week, energy. It had been a leader all year. We've talked about that at length, and we saw it pull back considerably. It dropped 17% this week. I mean, Steve, 17% for the leading sector. What do you make of that?
Yeah, it's no good. And I mean, just to touch on what you were just talking about, this was a rough week for markets, right? A really ugly week. Thursday and Friday of last week were nasty, back-to-back gaps lower, big moves. And then we got the downside follow through this week. What we didn't get, in my opinion, is any real evidence of capitulation yet still, right? So how do market bottoms occur? They occur on high volume, right? We don't have that. Put call ratios blow out. We don't have that. The VIX typically spikes. We don't have that. Usually there's breadth divergences in the sense that the stock market, the market of stocks, have already printed their low for the cycle in terms of new low readings or any type of breadth deterioration reading. And then you typically see that start to heal and improve. And you usually have a positive breadth divergence in place. We don't have that, right? So as bad as things are, I look at a chart like of the Russell 2000 while I'm thinking about all the things that I just said. Seems like they got to get worse, right? A lot of people don't want to hear that. But listen, if the average stock, the Russell 2000 or the value line is below those 2018 highs, there's nothing good to say about risk assets right now. In fact, the list of negatives is just growing. Ian's going to touch on that with copper, gold, and I'm going to talk about it right now with energy. So the biggest thing that happened this week, and a lot of stuff happened, was we lost the only leader that was left, right? So go back to my spooky meme.
I love this. Sure.
Yeah. Right. But this is the environment that we're in, right? Bears came for everything already. And we've talked about it on the show, Pat. We've talked about it probably ad nauseum over the past several weeks to several months. Energy. Yeah,
we're starting to sound like a broken record there. Every week, it was just energy was the only place to hide, and it couldn't be a more different story this week.
But didn't we also talk about how, as participation continued to thin out, that energy became more and more vulnerable? Right? I remember
absolutely
like a target on their backs. This image, illustrates exactly what we're talking about.
Right. It should come as no surprise. I mean, if anything, it was surprising that you saw energy up 60, almost 70%, while the rest of the market's entering bear market territory. I mean, whew.
Right.
So that was the surprise. This, should come as no surprise, I guess.
Right. So while we weren't like sitting back and making the bet, hey, energy is just going to keep doing its own thing while the broader market falls apart, we were kind of holding out. Not hope, because you never want to hope, but we're holding out like the possibility that maybe the broader market just catches higher to energy. We now have the answer to that, right? It's not happening. Energy is catching lower. And when you see the worst thing about this week, if you're bullish energy, is the manner in which this sell-off happened. that's so important always. It's something that often, isn't touched on enough, especially from a tape reading perspective. The way that these stocks sold off this week was awful, right?
Yeah, I mean, worst week for the energy sector since I believe it was March 2020. I mean, even when crude oil went negative that week, it wasn't as bad as this week for energy stocks.
And if you just remove COVID from this whole equation, it's the second worst week in history for the sector spider energy ETF XLE, dating over 20 years of history. It was the only time that we had a worse week for energy stocks was during the financial crisis. So what this really reminds me of, if you want to flip to the materials chart,
sure,
is the way that metals and mining stocks and material stocks kind of fell off and started getting sold back in April, because we have to remember they were leaders not too long ago also, right? It wasn't very long ago that we were having this conversation about commodity stocks being leadership. Then it became just energy stocks when we lost materials and metals and mining. They sold off really hard. They got oversold. There was some serious damage. The downside momentum really stood out. And we're seeing that now with energy stocks. That's the rate of change. That's what the rate of change is telling us, right? The sellers are feeling really aggressive. Okay. So that begs the question, okay, now that we've lost energy stocks, what's left from a risk asset perspective? Maybe energy futures. And I think it's really hard to try and make the argument right now that they don't also soon follow. You have that shelf of former highs. We're now back below it in energy, went up, kissed those, pre-financial crisis highs back from 07 or 08, which is failing a very logical level. And when I look at the chart of crude oil, I see something similar. Shelf of former highs, really logical level, momentum waning. We could draw some bearish momentum divergences on these charts if we wanted to, I'm sure. So I hope I sound more bearish than I've ever sounded on this video, because that's how I feel.
You hope.
I'm going to give it to you. Yeah.
I think it's really simple. 79-ish, 80, whatever you want to call it, for XLE has been the level, and we're back below it now, right? So, that certainly looks like a fail breakout to me. And you touched a little bit on crude oil there, but Ian, I know you watch crude and other commodities very closely. So you want to kind of walk us through what you're seeing on crude and kind of some of the levels you're watching?
Right. So just as Steve pointed out, crude oil is running to a shelf of former highs going back to 2011, 2012, 2013, and finding resistance. And today, crude oil, like the energy sector, is down big, down over 10% this week alone. So, running into overhead supply at a logical level and rolling over. This is the one area of the commodity space that has really been leading. For the past 2 months, most commodities have been chopping sideways. So to see this leadership group run into overhead supply and turn lower isn't a good look for commodities as a whole. Big question over the past, few weeks that we've been tossing around internally has been, okay, so commodities are in a corrective phase. Are they going to correct through price, or are they going to correct through time? Up until today, it looked like they were hanging in there, and they might correct just through time. But seeing crude oil and energy act the way they did today, and then seeing copper break down out of its year-long range.
Yeah, a lot of people talking about that breakdown in copper today. What is that, a new 52-week low today? Or
yes, new 52-week lows on a closing basis. That's a really big deal. Seeing Dr. Copper roll over and not be able to hang in there is a really big deal, not only for commodities, but for risk assets in general.
Do you want to go into that a little bit further, why it's a risk-off signal?
Right. So, strength in copper speaks to economic growth and just market health. And to see copper roll over just doesn't bode well for risk assets. And the same can be said for copper relative to gold. And what you have in that risk ratio is copper risk asset versus a more defensive asset or safe haven asset in gold. So to see copper underperform a more defensive asset speaks to risk aversion and risk off. And that's what we're seeing today.
And two, like, it's been our thesis that this is a new commodity super cycle. Okay. Copper is as pro-cyclical as it gets. Crude oil has probably more things going on from a supply and demand dynamic right now. Copper, if it's going to trend sideways like this in what we would call continuation pattern since last year, that's fine. Sideways is fine, right? The underlying trend is still higher. We've been looking at this range in copper for over a year now, saying, all right, the weight of the evidence suggests we'll get an upside resolution eventually. And then, we can be comfortable that commodities as an asset class are really resuming their uptrend. Copper needed to join that party. It never did. A lot of commodities, Ian could riff on this, for days and give you all the commodities that have just kept resolving higher. Copper hasn't been one of them. I would argue it's probably the most important as a commodity bull. That's probably the one that we needed to go most. It never did. And now instead of pressing on the upper bounds of this range, like crude oil still is, it's pressing on the lower bounds, threatening to break down. If we start seeing, breakdowns from these continuation patterns and things like copper, materials, metals and mining, agriculture stocks, what does that say for the whole commodity supercycle thesis, right? We're starting to see these continuation patterns turn into topping formations.
Right.
Yeah.
Right. And that's a really good point, Steve, is that by definition, if these continuation patterns do not resolve in the direction of the underlying trend,
and they weren't continuation patterns,
they're reversal patterns. Exactly. Right. And to see Dr. Copper resolve lower and join the long list of risk assets that are completing significant topping patterns, it's not a good look.
Because for the longest time, right, it's been since early last year now that a lot of these key cyclical groups have just gone sideways, and that's been fine. You were talking about the difference between correcting through time and correcting through price. Up until now, copper's been correcting through time. Now, if it starts to correct through price and this continuation pattern becomes a distribution pattern or a top that completes to the downside, then we have structural damage. And then we have to start calling that whole, bull market thesis for commodities into question. So that's what's going on right now. I would argue. Is that fair? Am I being too bearish?
No, I think it's really interesting that, it seems like we're already pretty far along in this bear market for risk assets, if you want to call it that. And yet we're still getting more bearish evidence. I mean, I didn't even think to look at the commodity markets for bearish evidence there, just bearish evidence of general against risk assets. But man, you're absolutely right. Copper breaking down, that's bearish for risk assets.
And it's not just any old more bearish evidence, right? If mobile payment stocks were breaking down or something, I'd say, great, of course they are, right? We would expect that. These are the leaders. Not long ago, we were looking at these areas like metals and mining material stocks, calling them leaders. These groups are core to that whole idea, that whole pro-cyclical, growth on, risk on, commodity type theme. And you're getting, the bears have really done some damage to that whole thesis. I think just recently, sideways was fine for these trends. Lower is not.
Yeah. And man, did they go sideways forever. I mean, copper and copper gold have just been doing nothing for, I feel like over a year now. But, we can't talk about copper gold without talking about interest rates. And there was a lot going on there this week. The 10-year hit its highest level since 2011. And the past couple of days, it's backed off a lot. So Steve, you want to take this one and just kind of break us down through what you're seeing in 10-year yields and the dollar index?
First of all, let's get the dollar out of the way. It looks like this thing's going higher. It really looks like this range is resolving higher. We had a quick little false start. You could see it in the chart, hooked lower, and it really looks like we're going. Any objections to that, Ian?
No, sir. I agree 100%. So I think we're getting a little stutter step here, right, and we're headed higher.
And that makes sense, right? In an environment where we're talking about copper violating, key former lows and breaking its range lows and completing a top, the dollar happens to be breaking out. Makes a lot of sense to me that those two things are happening at the same time.
Yeah, in fact, I think you said it last week. You said, if the dollar does break out of this 20-year base, then maybe we finally start to see dollar strength be a problem for commodities. And that's what we're seeing this week.
It's almost as if market participants were like, that's cool. The dollar can rise. The dollar can trend higher all through last year.
But it can't break 20-year highs.
But don't let it establish a new range, right? Don't let it break out of a major base like this, because then you got to say, all right, we got to anticipate an up leg. How much higher does it go? Maybe this is market participants saying, almost capitulating on that bearish dollar trade and accepting the fact that dollar's going higher, and you're finally now starting to see it in the commodities market. I think that makes a lot of sense. Let's wait and see what these next few weeks bring. I think copper is the first shot across the bow for that theme.
Yeah, and copper gold breaking down, that's telling us that 10-year yields will probably resolve lower too. Is that fair to say, Steve?
Man, no.
You don't think so?
I think you're going to see some intermarket relationships really decouple. Maybe that's one of them, maybe not. I wouldn't. It's been a great indicator for yields in the past. Well,
for decades.
Yeah, but this is a regime change. This is now a super inflationary environment. I don't want to cling too closely to intermarket relationships. I want to give them room. I'm not saying I think they're going to decouple, but I'm not going to give them as much credence as I would have in the past in a deflationary environment, the ones that were used to those relationships really holding up really well in. Does that make sense?
That brings me to another question. So, you have the 10-year yields and the dollar have been moving higher together all year. Speaking of relationships decoupling, do you think you could see a scenario going forward where yields and the dollar stop moving together and maybe dollar continues higher and rates roll over?
So, yeah, there's a funky situation.
You know what I'm
saying? Yeah, definitely. There's a funky situation with yields right now. I think some churn, some chop, some consolidation here would make a lot of sense. I think we get that at this 3% level. And here's the problem with yields. There's upward pressure on yields from federal central banks all around the world. It's not just a US thing. Then there's downward pressure on the longer end of the curve because there's not just recession talk in the media. There's probably actually some sort of growth slowdown coming. I'm not going to use that word, but there's a growth slowdown coming. And that's being reflected in the longer end of the curve. Right? So you have that pressure there. So you have two competing forces, and it's kind of like who's going to win out right now. And the main reason why I care about yields right now is because I think the weakest stocks in the market, by that I mean the long duration growth stocks, right, will catch a nice bid and probably do a lot better in an environment where yields start to maybe correct more through price, right, and come down a bit from that 3% level. I think you'll probably see a nice bid in growth stocks. But there's a bigger issue with that at this point, with the Fed really digging its heels in and saying, we're going to continue to hike aggressively. Would really expect to see that 10-year go. It really should keep going. If it doesn't, I think it almost speaks to a larger problem than, oh boy, higher yields are putting pressure on growth stocks. I think at a certain point, growth stocks can only get so cheap, right? A lot of them are in 80, 90% drawdowns. Yields can probably keep, ripping higher and maybe keep a cap on growth stocks, but I don't know if they can drive them all the way to zero. I know they can't do that, right? Just from higher interest rates. So I think there's a point at which yields can only go so high, and then growth stocks are like, all right, we've been hit enough, and probably stop falling. Now, on the other side of that coin, if the 10-year is going to roll over here and fail at 3%, I think it speaks to a much larger issue about the broader economy and growth in general that would probably have a negative impact on all stocks. So I think we're in a pickle when we talk about interest rates, a bear pickle where higher is not so much better, but lower is not so much better either at this point.
Yeah. Well, we're heading into a 3-day weekend. It was quite the week in the crypto markets, just about every other asset class too. But why don't you walk us through your thoughts on Bitcoin? We're right near those 2017 highs, testing those key levels. Go ahead.
So we talked about losing the leaders. We talked about more and more tops breaking down. I think we lost large cap healthcare last week. We're losing large cap materials this week. We also lost Bitcoin. A lot of people forget Bitcoin has been a leader in terms of growth stocks. Bitcoin has been one of the stronger growth stocks, if we're calling it a stock, right? Because if we were to zoom in on this chart, you would see a top that had not completed up until earlier this week. It was holding that 29,000 level. It was holding its lows from last year, right? And not breaking down from a distribution pattern like we had seen so many other risk assets already do over the past 2-3 quarters now, right? So now we've lost Bitcoin. Add that to that list, a growing list of completed tops, right? Right back to that 20,000 level. Will it act as support? These 2017 highs, I would look to Ethereum, right? The 2017 highs did not act as support for Ethereum.
Just slicing right through. Wow.
That's it. So I have nothing bullish to say about anything today. I'm very sorry. Have a good weekend, everybody. No, I'm kidding.
Well, so are you still watching that correlation between stocks and Bitcoin, or more so the NASDAQ and Bitcoin? It's broken down a little bit, but it's totally still there. What do you think?
Oh yeah, absolutely. They're gonna move in the same direction. I'm really confident of that. Until we see that correlation decouple, that's the best evidence we have outside of price action itself for crypto markets. Is what NASDAQ do, and vice versa, right? So we always end with like a chart of Bitcoin on these calls. The reason for that is because we're not going to have stock prices for 2 days. Well, in this case, 3 days, right? So we're going to be looking to Bitcoin for the next 3 days for a clue on where we're headed Monday.
Awesome. Well, guys, thank you for coming on and sharing your thoughts and charts. I wish we had more bullish things to say here, but you guys are telling it like it is. So appreciate it, and have a great weekend.
This is awesome. We should double team you more often.
Oh God. Might have to edit that part out. Anyway, thank you guys for watching. If you enjoyed the show, please click like and subscribe. And don't forget, it's a 3-day weekend. So shortened holiday week next week. Thank you guys.